My dear children, myself Mr. Pranay Vidyut, who is before you, representing Masterminds Educational Institution to discuss MTP of Advanced Accounting. Let me start. And to tell you, point number 1, mock test papers which are released by institute are at par with public examination guidelines itself. I mean to tell, some questions will be tricky, some questions will be easy depending upon the elements, and this MTP especially is pretty simple. Every question you have got just from the material of the institute itself, and hope the same should happen even with your main examinations also. And let me start. As usual, first you will be having MCQs and then one compulsory question and then remaining questions. So now let me start with MCQs. Case scenario. Fly Limited made a sale of INR 7 lakhs to Wings International in May 2023 and recognized trade receivables which was initially recorded at a prevailing exchange rate on the date of sales, that is transaction recorded at US $1 is equal to 79.4. So you must understand that Fly Limited made a sale of rupees 7 lakh to an international company which was initially recorded at $1 is equal to 79.4, which implies that already they have converted. Already they have converted foreign currency into Indian currency and they have recorded. So you have to remember one thing which is very important, that AS11 will not deal with the conversions from Indian currency or reporting currency to foreign currency, but AS11 will be considering the conversions from foreign currency to reporting currency. Here given at rupees 7 lakh and 79.4 is the recorded price given. Don't confuse that. You are converting into how many dollars? Initially, if I would like to tell you, then 7 lakhs divided by 79.4, which comes to $8816.12. It appears, it seems to be appeared something like you are converting from reporting currency to foreign currency. But the downline is all about already they have converted and they have written, and we are just provided a reversal of information. So this is just given to confuse you. Apart from that, nothing great. But the greatest part is that if you are checking out the MCQs, nowhere it was given that AS11 is not applicable. So absolutely we are very happy. We can get it very easily. Anyways, let me continue. And also the company took a loan for rupees 10 lakh in December 2023, which was initially recorded at a prevailing exchange rate on the date of transaction, where the transaction was recorded at US $1 is equal to 81.1, which implies that rupees 10 lakhs divided by 81.1, which comes to $12330.45. Now, let me proceed further. On 31st December 2024, exchange rate was $1 is equal to 83.3. So, this is the closing rate which was given. So, you were provided with two spot rates. One spot rate is at the time of sale and another spot rate is at the time of taking the loan, and we were provided with the closing rate. Now, let us start checking over to the MCQs. Now, coming to the MCQs, first one. What will be the closing balance of trade receivables on 31st March 2024? Sir, trade receivables. As per the provisions of accounting standard number 11, first of all, you must decide whether is it a monetary item or a non-monetary item. Of course, trade receivables is a monetary item and also loan is a monetary item. And since these are monetary items, at the year end, which goes for subsequent recognitions, you need to consider at closing rate. So, $8816.12 multiplied by closing rate 83.3, which comes to rupees 734,382.7, 734,382.7, that is 383 approximately. So, which is a perfect answer, and the correct answer goes for bit number 3. So, let me cross check with the same. Yes, bit number 3, which is perfectly correct. Now moving on to the next thing. How much is the reporting difference, gain or loss in respect to trade receivables? Very simple. My initial rate is 7 lakhs and now my subsequent rate is 734,383. So the difference is nothing but 34,383. And for your kind information, it is increase, in the sense receipt increase. So it's a gain, and the correct answer is 1. Moving on to the next thing, what is the closing balance of the loan as at 31/3/2024? Okay, so dollar 12,330.45 multiplied by 83.3, which comes to 1027,126. 127 approx, that's bit number 2. And obviously this loan is something like loan raised, right? Yeah, took a loan, so it's a liability. An increase in liability is there, so 27,127 loss of 27,127, so which comes to bit number 4. If you want, you can take the difference of initial and subsequent directly, or you can also compute something like dollar 12,330.45 multiplied by 83.3 minus 81.1. 83.3 minus 81.1, 2.2 per dollar is the loss, multiplied by 12,330.45, where you have got 27,127. 27,127. If you want, you can also compute like that by taking dollars into initial recognition minus subsequent recognition, and you can find whether is it profit or loss. Anyways, the answers are 3, 1, 2, 4. 3, 1, 2, this is wrong, and this is obviously 4. Of course, there is no exaggeration that in MTPs and RTPs, obviously there will be some mistakes. So be careful, don't blindly follow them. You first solve and then cross check. Otherwise, you will be in a danger zone, remember. Let me continue with second case scenario. And the second case scenario, X Limited purchased 3000 shares of Amazing Limited in December 2023 at rupees 100 each and paid a brokerage of 1%. Okay, so something like relating to ACE 13 investments. The previous case scenario is relating to ACE 11, the effect of changes in foreign exchange rate, and this is relating to accounting standard number 13, which is nothing but accounting for investments. Anyways, so purchase 3000 shares. Okay, so it is something like purchases 3000 shares multiplied by 100 plus 1%. So the cost price comes to 3000 into 100 plus brokerage of 1%, which is rupees 3,03,000. In May 2024, Amazing Limited issued bonus shares for 1 for every 3 held by the shareholders. So bonus 1 for every 3, in the sense 1:3. So 3000 divided by 3, you will be getting 1000 at a price of 0. So the cost of bonus is obviously 0. Next, X Limited sold 1000 shares in September 2024 at 110 each. X Limited sold 1000 shares at 110 each. Okay. Now, take care. It's obviously you need to understand one thing, that the cost of bonus shares is 0, and while selling the shares, you are not allowed to choose specific identification method. You will be getting weighted average method for sure. So obviously, let me find weighted average price here. The total price is 3,03,000 and the total number of shares are 4,000, and we have actually sold 1,000 shares. So 3,03,000 divided by 4,000 multiplied by 1,000 shares. On a whole, it comes to an amount of rupees 75,750. This is your cost of shares which were sold. And at what price? Let me check out. At 110 each. So they have sold at 110 anta. So selling price is equal to 1000 into 110, which comes to rupees 1,10,000. So 1,10,000 is sold at a price of 75,750. So automatically you are going to get a profit of rupees 34,250. Let me go back. After the issue of the bonus, the shares were quoted at rupees 95. Let it be. At the end of the year, in December 2024, the shares were quoted at rupees 70. Okay. So you need to consider only at the end of the year. Okay. And actually, after selling 1000 shares, my remaining shares were 3000. And also we found that per share price is 75.75. That is 3,03,000 divided by 4000 we have got. So on a whole, you will be getting something like 3000 shares into 75.75, which comes to 227250. And the closing price is rupees 70. Okay. 70 into totally you are having 3000 shares, which comes to 2,10,000 only. Okay. So let me continue with each and everything individually. So cost or NRV, I mean to tell, since nothing is given and also purchased shares, sold some shares, obviously this is a kind of current investment, and current investments will be valued at cost or fair value, whichever is lower. And the cost of closing shares were 2,27,500, and cost of closing fair value of closing shares at rupees 70 comes to 2,10,000. So cost or fair value, whichever is lower, which comes to 2,10,000, leaving 227,250 minus 2,10,000, 17,250 as loss in the context of closing. So let me continue. What are the requirements is he asking? First one, what would be the carrying amount of investments in Amazing Limited after sale of shares? After sale of shares, totally you are having 4000 shares, but you have sold 1000 shares, so you will be left only with 3000 shares at cost price, which is 227,250. Option number 2. What is the cost of bonus issue? 3. Option number 3. What is the profit on sale of bonus shares? Sir, if you observe here, sold rupees 1000 shares. He did not tell whether they are bonus shares or not. In the question given, sold 1000 shares. Ante. But here they are asking what is the profit on sale of bonus shares. Don't confuse, which implies that those shares are nothing but bonus shares itself. And remember, don't think something like, since I have sold bonus shares, cost of bonus shares is 0. I have sold it for 75,750. So 0 is sold for 75,750. I got a profit of 75,750. No, that's wrong. Because you need to apply weighted average cost method here. And hence the profit is 34,250, which is bit number 3 again. But it's not 75,750. Be careful, because what happened ante, cost of bonus shares is 0. And the selling price is 75,750. So you'll be thinking that 0 is sold for 75,750 and profit is 75,750, but absolutely not. Reason being, you have to apply weighted average cost method if nothing is given, and hence 34,250 is the profit. Take more care. What would be the carrying cost of investments in the quarter ending December 24? Okay, it might not be year ending, but somehow it's quarter ending. Anyways, it must be valued at cost or fair value, whichever is lower. So which comes to rupees 2,10,000. So bit number 1. And the answers should be 2331. Cross check. 2331, which is perfect. And my dear children, that is the end of question number 2. To tell you, it's a problem. Very, very simple problem. And let me start with case scenario number 3. Sun Limited has acquired 40% of share in Moon Limited for rupees 5 lakhs on 1/7/2023. So if I was not wrong, this is 40% ante associate. So which is AS23. Accounting for investments in associates in CFS, mostly relating to that standard. Anyways, let me continue. So Sun Limited acquired 40% in Moon Limited, is having 40% in Moon Limited. Next, what happened? On 1/7/2023, okay, on a specified date, Moon Limited is holding 40% stake in Star Limited. Okay, Moon Limited is having 40% in Star Limited. Sun is having in Moon and Moon is having in Star. Now, Sun Limited can exercise significant influence on Moon Limited. If you observe here, this is associate, Sun is investing party and Moon is associate, relationship between Sun and Moon. Coming to Moon and Star, Moon is investing party and Star is associate. So I can also link not only ACE 23, ACE 18 also will be linked here. As usual, if you observe, Sun is having significant influence on Moon and Moon is having significant influence on Star. But be careful, Sun is not having significant influence on Star. Reason being, as per accounting standard number 18, associate of associate is not a relative at all. And hence Sun and Star are absolutely not relatives. This is something like associate of an associate. So they are not relatives. If at all, given here 60%, ante associate of subsidiary is a relative to holding again. Something like if Sun is having 60% and Moon is having 40%, at this time Sun can influence Star. Because associate of subsidiary may be a relative. Maybe kadu, it is a relative, but subsidiary of subsidiary is not a relative. So take more care. And let me proceed further. Moon Limited declared a dividend of rupees 80,000 for the financial year 22-23 on 15/9/2023. So it's obviously a kind of pre-acquisition dividend because my date of acquisition is 1/7/2023 and Moon Limited declared a dividend on 15/9/2023, that is after the acquisition of Sun. And this is for the financial year 22-23, that is the previous year. So this is pre-acquisition dividend, a kind of capital item. And next, for the year 23-24, that is current year, Moon Limited earned a profit of 4 lakh, okay, and declared a dividend of 90,000 on 15/9/2024. Until this declaration was happened in the next year. This is what the question, not a problem, this is just a question. So let's observe the requirements. With respect, yeah, if you want, you can also solve it at the initial part and then you can. So if it is of something like that, then my cost of investment is equal to rupees 4 lakhs, right? No, 5 lakhs. From this, I need to deduct pre-acquisition dividend. And my pre-acquisition dividend comes to, total is 80,000 into 40%. So I am going to get an amount of rupees 32,000. So you will be having 5 lakhs minus 32, that is 468,000. This is your net cost of investment. And value of net assets is not given in the question in order to find goodwill or capital reserve. But we know that an associate in CFS, the outer column should be cost of investment. Of course, it must be broken down between value of net assets and goodwill or capital reserve, but no data. So let me take the same here. And for this, you have to add current year net profit. And the net profit current year is actually rupees 4 lakhs. It is 4 lakhs. But take more care, my dear children. Out of rupees 4 lakhs, you have to consider it as revenue only from 1/7 because the date of acquisition is only from 1/7. Since nothing is mentioned, and of course, I'm sorry, mention here 23-24 is the financial year from 1/4. So 4, 5, 6, 3 months gone. In the sense, out of 4 lakhs, 3 months is considered to be pre-acquisition profit, which will be adjusted here. But the remaining 9 months is to be considered as post-acquisition profits, which comes to 3 lakhs. But even though it is 3 lakhs, you can't add it up totally because you need to consider only the share of associate. That is 3 lakhs. I mean to tell totally 4 lakhs into 9/12 and then multiplied by our share is only 40%, which comes to rupees 1,20,000. On a whole, it will become 468. 5,88,000. Now, if you observe, and further declared a dividend 90 on 15/9/2024. So deduct out of 90,000, we'll get only 40%, that is minus 36,000. So 588 minus 36 will be 552,000. And this 552,000 is the carrying amount as at 15/9/2024, that is in the next financial year, and this is at the current financial year ending in CFS, and this 4,68,000 is the value that shall be shown in SFS. And anyways, let me proceed further. Like if you observe now, what are the questions? With respect to the relationship between the companies, it can be said that Star is associate of Sun. Let me check out. Just now we discussed that associate of associate is never an associate, and hence Star is not an associate. Moon and Star both are associates. Wrong answer. Moon is associate of Sun. Yes, primary relation, which is perfectly correct. Sun Limited is parent of both Moon and Star. No. Only option 3 is correct. And next, what will be the carrying amount of investments in standalone financial statements of Sun Limited as at 31/3? Separate financial statements ante it comes to 4,68,000. That is option 3. And carrying amount of consolidated financial statements, which is 5,88,000, since it is considered at the end of the year 31/3, ante option 2. And my dear children, this 552 goes correct provided if he is asking as at 15/9. And what is the next one? As per AS 23, the existence of significant influence by an investor is usually evidenced in one or more following ways. Okay, he is indirectly asking, with significant influence, what can you do? Participation in policy making processes, of course, yes. Without that, significant influence is obviously not needed. Next, interchange of managerial personnel. Yes, I mean to tell something like one company's KMP can be moved on to another company. Absolutely, there's no problem. Right to receive dividend. No. With significant influence, you are not going to get the right to receive the dividend. You are going to get the right to receive the dividend only when the company declares. So it's obviously wrong. Provision for essential technical information. Yes, you can provide technical information. Absolutely no problem. So how many are correct ante? A, B and D. Pick out the options. Statements A, B and D are correct. Option 4. So if you check out 3, 3, 2 and 4, which is 3, 3, 2 and 4. Everything is correct. Let me move on to the next thing. Cost of current investment acquired is 1,000, but the fair value is 800. Okay. At the time of acquisition, current investment comes to rupees 1,000. Maybe at the end of the year, the fair value is rupees 800. And hence investment was recorded at rupees 800 only, which is something like cost or fair value, whichever is lower, purely as per accounting standard number 30. Now the fair value is 1200. Might be at the end of further year, the fair value increase it to 1200 rupees. Now how much gain you can record in P&L account? My dear children, it's as simple as such. Your cost of investment is 1000. Year end value is 800. Further year is 1200. But hope you have remembered that the current investments or even the long-term investments can't be increased more than the fair values. You can increase, more than the cost price. You can increase only to the extent of cost prices. Hope you have remembered that. So 800 can't be increased up to 1200. You can increase only up to rupees 200. That is up to 1000. So let me show you the actual provision. Accounting standard number 13. Where the valuations. Yes, check out. Current investments valuation, which is like for current investments, any reduction to fair value and any reversals of such reductions can be included in the P&L account, but it could be prudent estimate that the reversal can't increase the cost price. So here if you observe, 800 is the book value at the end of the year, and further year, if even though it had become 1200, you can increase, but the increase should be only up to cost price, that is only 200. So let me check out point number 1. No change is required and it will continue at 800. No. Current investment will be recorded at 1000 initially. Yes. and a gain of 200 will be credited to P&L account. Yes, this is correct only. But let me find if any perfect, and I mean to tell more clear answer is there. Like initially 200 is charged and then 200 is reversed. But let me check out. Current investment is recorded at 1200. No, that's prima facie wrong. Recorded at 1200. So wrong. No need to check further elements also. And hence second bit is correct. Second bit is correct. Let me go with the fifth one. As per accounting standard number 20, an enterprise should present or disclose the following. The amounts used as numerators in calculating basic and diluted EPS and a reconciliation of those amounts to the net profit or loss for the period. Yes, correct. It has to, as per accounting standard number 20, an entity has to present the computations of numerator separately and also the denominator separately. And hence, if you observe, the point number B is the weighted average number of shares used as denominator and reconciliation of those denominators. Yes. And basic and diluted, even if the amounts are disclosed as negative, perfectly correct. The nominal value of shares along with EPS figures. Yes, correct. Because you might have different classes of shares for which you have to disclose different values of EPS also. And hence you have to disclose nominal values along with the different EPS that you have got. And to tell you all the statements are correct, first one is perfectly true. And let me go with the last and final one, that is sixth one. Is 10 pp is applicable for biological assets other than bearer plants? No. That prima facie initially covered under non-applicability of scope. And the next one, vesting assets including mineral rights. No, for vesting assets AS10 is not applicable. And also AS10 is not applicable for inventories. Reason being, for biological assets relating to agricultural activities, there is no specific accounting standard, but Ind AS is going to take care about it. And for vesting assets, again the same IGAPs, Indian generally accepted accounting principles, and corresponding Ind AS is going to take care. Inventories, accounting standard number 2 is going to take care. And if you observe, AS10 is applicable for bearer plant but not for produce on bearer plant, for which Ind AS, respective Ind AS like 41 for these things is applicable. So AS10 is applicable for bearer plant except on the produce of the bearer plants. And the correct answer is option 4. And my dear children, this is what your absolute discussion with MCQs, which is absolutely done. And let me start with descriptive. But the greatest part is that descriptive questions are pretty easy, because everything is like almost copy paste from your material, institute material itself. Let me start. Question number 1 is of course the compulsory questions, and you need to answer any 4 of the remaining 5. On a whole, you are supposed to answer 5 questions. And let me start the compulsory question. And if you observe, this question is provision as per AS 29 and relating to AS 29, of course. Now, a limited provides after sales warranty for 2 years to its customers. Okay. Based on the experience, companies having the policy for making the provision for warranty on the invoice amount, very important, on the remaining balance warranty period. If the remaining balance warranty period is less than 1 year, 2% is the provision, and the remaining balance warranty period is more than 1 year, then 3% is the provision. And companies are having invoices like 11th February 2022, 25th February 2022, 4th October 2023. And the warranty is provided for 2 years. First of all, let me find the expiry of the warranty period plus 2 years, which comes to 10th February 2024 plus 2 years, 24 December 12, 2024 plus 2 years, 3rd October 2025. Okay. Calculate the provision to be made at the end of year 31/3/2023 and 31/3/2024, and also compute how much amount will be debited to P&L account at the end of 31/3/2024. Okay, let me start a very simple question. First of all, at the end of 31/3/2024, and identify the sales that were happened on or before 31/3/2024. sorry, 31/3/2023, first year, I'm sorry. So first provision you need to make at 31/3/2023. Identify those sales which were happened on or before 31/3/2023. These two things. Because 4th October 2023 is not a sale happened on or before 31/3/2023. So on or before 31/3/2023, only these two were happened. Strictly speaking, in 22-23, only this sale is happened. And this sale is happened in the previous financial year, that is 21 and 22. But for creating the provision, you need to consider the balance of warranty period. That's very important. So on or before 31/3/2023, these two sales were happened, and the warranty period is, expiry date of warranty period is 10/2/2024 and 24/12/2024. Now, as on 31/3/2023, okay, the balance warranty period from 31/3/2023 till 10/2/2024 is less than 1 year. If it is less than 1 year, the balance of provision will become 2%. And 31/3/2023 to 24/12/2024, and almost 1.5 year is there, on which you have to create 3% provision. So 60,000 into 2%, 1200, and again 1200, 40 into 3. On a whole, 2,400 is a provision required as at year ending 31/3/2023. And as at year ending 31/3/2024 ante, on or before 31/3/2024, of course, yes, all these three sales were happened. Okay. Next, now you need to check out the balance of warranty period. 31/3/2024 to 10/2/2024 already expired. There's no balance warranty period, and hence provision is not required on this for the next financial year. From 31/3/2024 to 24/12/2024, the balance warranty period is less than 1 year, and hence on 40,000 you have to create 2%, which comes to 800. And from 31/3/2024 to 3/10/2025, almost 1 year, 3 months you are having, on which more than 1 year, and hence it comes to 3%. That is 135,000 into 3%, which is 40/50. On a whole, it comes to 48/50. This is the provision required at the end of 31/3/2024. Since in the first year the provision amount is 2,400, and in the next year we need 4,850, and since in the question specifically he did not give there are claims for warranty, assume that there are no claims for warranty, and already created provision is 2,400, new provision required is 4850, and hence newly 2,450 is to be debited to P&L account. And my dear children, that's the end of question number 1A. Now let me proceed for 1B as per the provisions of AS 26, very clearly given. Deal the following: 23 lakhs paid by a manufacturing company to the legal advisor for defending the patent of a product is treated as capital expenditure. For defending the patent, capital expenditure. No, this is to be charged. Revenue expenditure. During the year, company spent, because defending is not going to increase any future economic benefits. It is just going to maintain the future economic benefits. As per AS 26, you are supposed to recognize subsequent expenditure as an asset, that is capitalized, only when future economic benefits are increasing, but not for maintenance. For maintenance, if you are spending any expenditure, it must be charged to P&L account. And next, company spent 7 lakh for publicity and research expenses, marketing in the same year, but proved to be a failure. No future economic benefits, and hence even this has to be charged. Company spent 25 lakhs in the past years to develop a new product. Okay, these expense charged to P&L account since it did not meet AS 26 criteria. Might be development criteria. If you have remembered, it should satisfy the definition of asset, intangible asset, and 6 conditions. So the criteria was not satisfied, and hence it might be charged to P&L. In the current year, approval of concerned authority is received. Very good. And from the current year, the expenditure can be capitalized. But remember, once charged the past expense, it can never be capitalized. But company is wishing to capitalize 25 lakhs as if it's a prior period item. No, that's wrong. It continues to be charged. And moving on to the next thing, A company with a turnover of 200 crores had gone with an annual advertising budget of rupees 50 lakhs. Okay. And for marketing a product of a new company, it was estimated that it would result a turnover of 20 crores and the company had debited to its P&L account the total expenditure. Okay, simply they are telling that expenditure is 50 lakhs and with the help of this expenditure, they can increase the turnover by 20 crores. Don't think that since because of this expenditure, future economic benefit is getting increased, I have to capitalize. No, because with expenditure like advertisement, you might increase the future economic benefit, but there is no control on that. In the sense, prima facie asset definition is failed here and hence you can't capitalize and this is obviously to be charged. That's it. And of course 1C also you are having, but let me cross check with answers 1A and 1B first for you. 1A, yeah, 2450 and 2400. 1B, first one should not be capitalized, no benefit and hence expense. It should be recognized as an expense. Yes, and 50 lakhs. Treatment is correct. Everything is correct. Let me proceed on to 1C. Trade discount and how the following elements will be treated as per accounting standard number 9. Trade discount and volume rebate received. It's not a revenue, it has to be deducted from revenue. Where the goods are sold to distributors or others for resale. So, if at all sold to distributors, it actually depends on the facts and circumstances. If risk and rewards and ownership are immediately transferred and a sale is not subjected to return of goods, then you can recognize immediately. If sale is subjected to return of goods, which implies that risk and rewards are not yet transferred, in such a case, don't recognize immediately. Recognize only when the third party had sold. Where seller concurrently agrees to repurchase the same goods at a later date, it is not at all dealt by accounting standard number 9. It's a kind of accounting standard number 19. This is an arrangement of finance, not AS9 at all. Insurance agency commission for rendering of services. If it is a new policy, whenever the new policy is approved. If it is a renewal policy, whenever the renewal is done. On 11/3/2024, clothes worth 50,000 is sold to Xmart. But due to refurbishing of their showroom being underway, on their request, clothes were delivered on 12/4. So, sale was done on or before 31/3, but the goods were delivered after 12/4. Since the date was not given, it deemed to be implied that 31/3 is the cutoff date, that's year ending. Now, is the sale to be recognized in the year 23/24 or 25/25? As simple as such, it must be recognized in the year 23/24 because here delivery is delayed at buyer's request. But buyer accepts the billing, title is transferred, goods are ready, packed, everything is done. And hence, it's a deemed assumption that goods are ready for delivery, identified and packed. And hence, you're supposed to recognize on or before 31/3, that's like 23/24. Let me identify the answers for you, my dear children. Trade discount, not the revenue, reduction of cost will be deducted while computing the revenue. Sold to distributor depending upon the ownership passing. Okay. Concurrently re-agrees to repurchase. It is not at all a revenue. Insurance agency commission, effective commencement or renewal dates. Perfect. Xmart accepts the billing. If Xmart accepts the billing and risk and rewards is transferred, then immediately it has to be recognized as the sale. That's it. Even though physical delivery is not yet completed. That's it, my dear children. That is the end of question number 1, a compulsory question. And let me continue further from question number 2. And question number 2, following is the trail balance given. Okay. Additional information. Okay. You're required to prepare MN Limited balance sheet and P&L account. Ignore previous year's figures and taxation, which is obviously preparation of financial statements. I mean to tell company final accounts. And if you observe, everything is pretty simple. But let me tell you some things on what you have to concentrate. First one, closing inventory is given in the trail balance, which implies that opening inventory is adjusted under adjusted purchases. Even institute material had taken adjusted purchase as purchase of stock in trade, but technically that is wrong because there is no head called adjusted purchases in statement of P&L account. So to the max extent of possibility, you are supposed to separate two items. Listen very carefully. With respect to purchases in statement of P&L account, you are having purchase of stock in trade and one more item, changes in inventories of finished good, work in progress and stock in trade, which implies that this is net purchases and this is opening minus closing. And we know that adjusted purchases is equal to opening stock plus purchases minus closing, which is technically, if I have written like this, opening minus closing plus purchases, then adjusted purchases is the combination of purchase of stock in trade and changes in inventories of stock in trade. So to the max extent of possibility, try to separate opening stock, closing stock and purchases. Now in this question, we are having adjusted purchases, we are having closing stock. Unfortunately, nowhere we were provided with the opening stock, and hence it is technically not possible to separate opening stock, closing stock and purchase of stock in trade, and hence it is recommended to to present in statement of P&L account by considering these two heads at a stretch. If you observe, as I said, institute material generally is not going to do that. Expenses, see here 320, purchases, it is booking here itself, but technically speaking it is wrong. A, purchase of stock in trade, and B, changes in inventories of stock in trade. These two things collectively 320. So be careful with adjusted purchases and inventories. This is special adjustment number 1. Now special adjustment number 2. Many of the people will be recognizing, will be presenting debenture interest as 100 under finance cost. As 20 under finance cost. How did you get that finance cost 20 ante? They will be answering something like, so since it was given in the question, we had considered it as 20. But remember, my dear children, this logic is wrong. Why? Because sometimes you might be provided only with 19. Sometimes you might be provided only with 21 or 22. Then what problem is there, sir? We'll take 19 and 21. Wait, that is wrong. Even when 19 is given, you're supposed to take 20. Even when 21 is given, you're supposed to take 20. Reason being, 10% debentures 200 is clearly given. So expenditure incurred or interest incurred is 200 into 10%, which comes to 20. So be very, very careful. Logically, don't take this 20 directly there. First cross check whether these two things are matching or not. If not, the difference will be either prepaid or outstanding. Next special element is all about interim dividend paid. So strictly speaking, first of all, dividend must be declared. Then the entry should be P&L account debtor to dividend declared account. And then it must be paid. Then the entry is dividend declared account debtor to cash or bank account. If at all these two things were done at the end of the year, then obviously there will be no interim dividend in your books of accounts. But if you observe here, say you have declared but not yet paid, then your interim dividend should depict a credit balance. But unfortunately, it was not at credit side, it was given at debit side, which implies that it was treated at par with expense, similar to expense, not at par. Which implies first they have paid the dividend. Since they thought something like they might have enough profits or they are having enough profits, and hence they have paid the dividend. And take care, my dear children, that dividend has to be originally deducted from the P&L account as an appropriation, but it should not be shown as an expense. And hence, if you observe in note 2, you will be deducting interim dividend as an appropriation. But first this should happen and then payment should be done. But as per the question, first payment is done. And of course, last and final special point is all about suspense account. It is highly impossible to finalize the books of accounts with suspense. You identify what are the errors and you need to rectify all the errors. And here given that this is the error, which is purely similar. Likewise, you have sold the asset, cash received. So suspense account represents cash received for the sale of machinery. Something like he had written like this: cash or bank account debtor to suspense account 4,000. But originally you have to record it with something like sale of asset. So cash 4,000 to machinery cost is 10,000. Accumulated depreciation, you have got 8,000. and the balance will be considered as profit or loss, which is nothing but 10 minus 8, 2 is sold for 2. So on a whole, you are going to get a profit on sale of asset to the extent of rupees 2. Where is that? Other income. See here. Profit on sale of asset, that's rupees 2. And my dear children, so now cash or bank is adjusted. Now you are supposed to deduct 8,000 from the accumulated depreciation, and you are supposed to deduct 10,000 from the machinery, and then you have to provide the depreciation on the machinery to the extent of rupees, 10% on the cost. Ante the PPE value plant and machinery is 770. On that you need to deduct 10 rupees, so 760. On 760 you are going to get depreciation at 10%, which comes to 76 in the current year, which is nothing but your depreciation and amortization, if I was not wrong. Yes. And moving on to the next thing, your provision for depreciation comes to opening balance 172 you are having. Let me check out. 172 minus 8 plus 76 is your provision for depreciation. Okay, that's it. And let me go with the additional information. Authorized share capital shall be disclosed separately under notes to accounts share capital. Independent value revaluation has to be shown separately under PPE land. Okay, and declare the final dividend on 2nd April. My dear children, you are not supposed to include this one at all, because final dividend is not recognized as a liability, since the reporting period ending is 31/3, but the declaration is on 2nd April, which is after the completion of the financial year. If needed, you can just disclose the same as dividend proposed under notes to accounts reserves and surplus. If you need, you can also write here proposed dividend 10% on the share capital, some amount, or you can just disclose as if it is a separate note. Such dividends will be disclosed only in notes. So take care, my dear children. That's it. Ante. And let me proceed with 3A. Pretty simple. Just by observing, I can tell that this is accounting standard number 20. Rights issue. Prior to rights is 2.5 lakh outstanding. Rights issue or 1 lakh. Rights issue price is 98. So immediately, yeah, this is cum rights price prior to exercise of rights. So immediately just find a theoretical ex rights price, which is nothing but original shares 2,50,000 into cum rights price, that is 102. Next right shares 1 lakh into right price, that is 98. 35 lakh 30,000 whole divided by total number of shares, that is 3,50,000. So you got something like 100.8571, but as we always ask you to take round off up to 2 digits in this context, so 100.86. Now immediately find an adjustment factor, which is cum rights price 102 divided by 100.86. You are going to get 1.01, where 1 will be for consideration and 0.01 can be computed as bonus. Such a simplest thing, and further you can solve it. 0.01 is a bonus in the sense multiplied by original shares 2,50,000. So 2,500 shares can be considered as bonus out of this 1 lakh. I mean to tell 1.01, right? So separate 1, 0.01. 0.01 into original shares 2.5 lakh. You have got 2,500 shares as bonus out of 1 lakh. So 1 lakh minus 2,500 ante 97,500 shares can be considered from the dates of rights issue, that is 30/6/2023, and 2,500 shares consider as if they are bonus, and consider right from the beginning of the previous year as the weight of these bonus shares. And moving on to 3B, which is very simple, internal reconstruction. Nothing great to discuss in this. Nothing is there to discuss. Only one thing, you are having a P&L loss of 563,750. You need to remove that. Preference dividend arrears, equity shares reduced by 5, cancellation of 45. Very simple. There is no special point, there is no difficult point, nothing is there. It's very simple. The nominal capital as reduced is increased to 812,500 for preference capital, and yeah, this is just like increase in authorized share capital. Note number 1, see here, authorized share capital. That's it. Very simple. Very simple actually. Okay. Moving on to the next thing, but a very lengthy question because he is asking you to prepare journal entries and balance sheet, and simultaneously you also need to draft capital reduction account in order to find the answer. Okay. Let me move on to question number 4. Financial details, retirement gratuity fund. If I was not wrong, amalgamation. Yes. Very simple. Again, a copy paste problem. Nothing great at all. But let me discuss some special points. Number 1, retirement gratuity fund long term. It is an external item and hence it must be transferred to realization account, but it should not be transferred to equity shareholders account. Take care. And in this problem, a special element you need to consider is goodwill. While computing the goodwill, remember, take average profits. As long as you're solving goodwill related concepts in CA Inter, remember that goodwill has to be computed by considering simple average profits only, but not weighted average until and unless it was given in the question. Now also while computing goodwill, very sure that you have to consider only normal profits. You should not consider abnormal. You need to consider only trading items. You should not consider non-trading items. So here there are 2 abnormal profits also. Credit of insurance claim is an abnormal item and hence you have to ignore that. And only one point. Yeah, embezzlement is also a kind of abnormal and hence you have to ignore. Something like exceptional and extraordinary items you have to ignore while computing the goodwill. Remaining all are okay. Now, even unrecorded current asset of 50,000, 15,000 is there. Let them take that 15,000 unrecorded current assets, absolutely no problem. And be careful coming to provision for doubtful debts 2.5%. In one of the problems, you need to compute 2.5% on the total debtors of rupees 3 lakhs. X limited absorbed by yes. In some problems, if you observe here an ICT, intercompany transaction or mutual owing 20,000 is there. So while computing provision for bad debts, he is deducting this 20,000 from 3 lakhs, that is 3 minus 20,000 and 2.8 lakh. On 2.8 lakh, he is creating the provision. So be very careful in this context. No need to deduct ICT if your transferee company is the creditor for transfer or company. But remember, if your transferee company is the debtor, then obviously you're supposed to deduct intercompany transactions and then you need to create the provision. Till except in this point, intercompany transactions will never be eliminated since the point of absorption is completed. You will eliminate intercompany transaction only after absorption. So be careful in this context. If transfer is debtor, deduct ICT and create. But in this context, transferee company is a creditor because trade payables of Y Limited include payable to X Limited. Be careful. Trade payables of Y Limited. So for Y Limited, X Limited is a creditor. X Limited is a transferee company and transferee company is creditor in this context and hence no need to deduct intercompany transactions. And having one more special items, that is all about this one. See here, as long as you people are in the classroom and as long as you people are in the what is it called preparation, you will be pretty sure that this equity shareholders is net assets method, not a net payments method. But the greatest doubt that you are going to get while you people are in examination hall, that is here equity shares of Y Limited will be issued shares at 5% premium. Is it net assets method or net payments method? Because 5% premium ante you can also consider 9 lakh plus 9 lakh is issued at a premium of 5% and something like 10.5. At that time you will get 85,714 shares. But reality is not that. You need to consider net assets method. Why, sir? Reason is pretty simple, that remember, if no number and no amount is given with respect to preference shareholders, then you need to consider existing number and existing amount. Point number 1. But if no number and no amount is given with respect to equity shareholders, then you should not consider just the existing number and existing amount. Reason being, equity shareholders are having right even in reserves and surplus and net assets of the company, and hence compute net assets method for PC to equity shareholders. If nothing is mentioned for preference shareholders, you can compute net payments method. If nothing is mentioned for equity shareholders, it is requested you to compute net assets method. If number of shares is given, take that only. But if number of shares amount is not given for equity holders, you have to be under net assets method. Take more care. And moving on to question number 5, very simple. A copy paste question from your institute material again, and this is nothing but uniformity in accounting policies. A very simple question. You just need to redraft the balance sheet. It's a simple, nothing great to discuss. Now coming to question number A, briefly explain the elements of financial statements. We have been urging the students a lot that you are going to get one compulsory question from framework for preparation and presentation of financial statements. So never leave that. Elements of financial statements is nothing but asset, liability, expense, income and equity. Take care, components is different and elements is different. Components until you are going to get statement of balance sheet, form of balance sheet, statement of P&L, statement of changes in equity, cash flow statement and notes to accounts. But these are elements like assets, liability, equity, income and expense. Take care. Yeah, asset, liability, expense, income and equity, whatever. Next. This is a disclosure question relating to preparation of financial statements. Alpha Limited has mentioned in the notes to accounts that during the year 24,000 shares were 10 issued as bonus. However, the source was not disclosed. Is that non-disclosure violation to Schedule 3? Absolutely not. Reason being, source is not needed. Just disclose for the next 5 years that you have issued the bonus shares for free of cost. No need to disclose the source. And coming to this B, very popular question, very important question from accounting standard number 19, the first pick of the examiner, that is sale and lease back concepts in operating lease. Conditions are very simple. Sale and lease back is an operating lease, then you are supposed to consider these things. First, you have to apply the common condition, and the common condition is all about if at all the book value is greater than the fair value, then immediately bring down book value to the fair value and recognize it as loss. And after that, you have to compare whether selling price is equal to fair value, selling price is less than fair value, and selling price is greater than fair value. If selling price is equal to fair value, recognize profit or loss immediately in P&L account. If less than fair value, if profit, then recognize immediately in P&L account. If loss, if lease rent compensates, then amortize. If lease rent does not compensate, then immediately recognize in P&L account. And if selling price is greater than fair value, profit or loss computed up to selling price is equal to fair value, you have to immediately recognize. In excess of fair value, whatever is there, that has to be amortized. Pretty simple, but very typical if you did not understand the concept well. So go back, revise carefully and go for your examination. And the last and final, very simple, journal entries in the books of branch A. Head office expenses 3,500 allocated to the branch but not recorded in the branch books. Okay, now let us record. This is an expense allocated by head office to the branch. From now it is an expense relating to the branch only. And the journal entry is all about expense to, if I pay to cash or bank, but it is paid by head office. So to head office. Depreciation on branch assets whose accounts are kept by head office. Ante fixed asset accounts are kept by head office, but depreciation has to be provided by branch. And the entry is depreciation account debtor to head office account since assets are not with branch. Branch paid 2,000 salary to head office, but the amount has been debited by the branch to its salaries account. See, branch paid salary to head office. It's not my expense. It's head office expense. So it should write head office to cash or bank. But unfortunately, it had debited to salary and hence rectify the same. Rectify or adjust. This is rectification. And the entry is you have to cancel salary and hence it's something like head office account debtor to salary. Head office collected 10,000 directly from the customer, but no intimation is received by the branch. Now since you have received the intimation, you have to record. If you have received, it is cash or bank, but since head office is receiving, head office account debtor to your debtor. and remittance 15,000 was sent by branch has not been received by the head office. Let it be something like a general policy that to whomever it is considered as transit, they will record it. Here branch sent but not received by the head office. So head office is the recipient and hence they will record. In branch there is no journal entry. Branch A incurred advertisement expenses 300 on behalf of branch B. Any branch incurring on behalf of any other branch, something like interbranch transactions, has to be recorded as if they are transacting with the head office. So this is something like expense paid for head office and the entry will become head office account debtor to cash or bank account. And my dear children, that is the end of your MTP discussion. Hope you have got crystal clarity and all the best for your examinations. Hope you have to rock in your examinations, and also hoping from the bottom of my heart that even your public examination paper should be this much simple. All the best.